Bob is talking about this idea that the internet someday is going to be a place. This is 1990s. Okay. The internet's going to be someday a place where people buy things online and then they tell everyone in the world what they think about the things. They rate them, and that's going to change commerce forever. And Bezos said, I love this idea and I would like your permission to take this and run with it. If you guys are good with it, I'm going to leave here. I'm going to go start up a company and I am going to put this into gear. And they told him, hey, go to it, man. And he says, do you guys want to own some of it? He said, no, just all you, go ahead. And that was the beginning of Amazon, which is like, what?
That's in the book?
Yeah.
I got to go look that up.
Yeah,
that's
check it
crazy.
Out. Yeah, I mean, that was like, oh, well, that helps explain how Bezos figures this all out, because he's a genius, of course, coming from rocket science. And these guys are all rocket scientists. That's the truth. They're all. Jim Simons is a literal rocket scientist, one of the smartest math guys on the planet.
Cool.
Anyway, just a little more of a side, and one more aside. Can I do one more aside?
I wonder if he signed up to be a beta tester of Starlink, because I'm debating if I should do that.
What?
That was a rocket scientist joke. No?
Oh my God. I don't get it. I'm such not a rocket scientist, you guys. I don't even get rocket scientist jokes.
It was actually an Elon Musk joke. Elon Musk is trying to launch a satellite network that will provide internet everywhere across the globe, no matter where you are at all times.
Whoa.
And it's called Starlink. And you can apparently sign up to be a beta tester of it whenever they launch it.
Oh my gosh, that'd be so cool.
I suspect you have to give something in return to the great overlord of Starlink, which is your data. Exactly.
Give your data.
Exactly.
Like, oh, okay.
Okay, so again, we want to talk about the checklist. We are fully in the middle of the management part of the checklist. It's very exciting. We're very into it. We're not trying to avoid it. But we've got one other little item of business that I think is important to put out there on this episode before it gets too old in the news. So, Dad, you wanted to give some info. Yeah, this is in the form of a public service announcement about a kid. This was out in Forbes on June 17th. So this is a kid, 20-year-old, who is trading with a brokerage site called Robinhood. Which is where a lot of young people have gone to trade because it was the first website that let you trade for free. Well, and it's an app. It's not a website. So it's like,
you're right. It's an app.
Easier
it's on your
to
phone.
Use. Yeah.
Yep. And so this kid does an options trade that he doesn't fully understand called a bull put spread. And the bull put spread structure is that you are obligated. If the stock price drops aggressively, you will find yourself obligated to buy that stock at a set price. And you hedge that by owning a right to sell that stock at a slightly lower price. And that difference between the price you have to buy and the price that you have a right to sell is called the spread. And it's usually somewhere between $5, $10, $20, something like that. So you can end up per share. And you can end up with $1,000. You could very easily have something like, I don't know, at a $10 spread, you could have 100 shares with $1,000, right? So you could have 100 shares. So and it could be that you're doing something in a stock that costs $2,000 a share. So you could be obligated for $200,000. Right? You don't have any money.
But the idea behind the bull put spread, right, is that you are actually only obligated for that spread amount. Is that right?
Right. For the 100 shares on the spread amount of,
because
let's say,
you've hedged
$10. Right. You've hedged it.
Okay.
Now, what happened with this kid?
But technically, you're saying technically what happens is that you are kind of on the hook for this, whatever it could be, many hundreds of thousands, depending on how much money you're putting into it. But the reality of it with the buying and selling is that you've set it up so that you're only at risk for that spread amount, correct?
Right.
Just making sure
we don't talk about all this on the show here, but just for this one thing.
Yeah, we're not getting into the methods of options here, but it just was something that seemed important enough to mention.
It is. What this kid died of was an illusion, which is
you haven't even
tragic.
said that he died. So what happened?
Oh, sorry. He committed suicide
Oh,
because On Friday night, his trade went bad over the course of the trade, and the stock price fell to where he was obligated to buy the stock. All right. But it didn't fall far enough to where the hedge covered the low end of his obligation. In other words, if there was a $10 spread, the stock price came down maybe halfway through it.
Okay.
All right. And the impact of that was that he woke up Saturday morning and his Robinhood brokerage account said, "You owe us $730,000." Because that was the negative position. He had to buy
that was the full position.
$730,000 worth of stock. What he didn't realize was that the Robinhood brokerage account would show on Monday at the open that his account had been cleared by selling the stock at that stock price. So he would have lost, in this case, maybe he would have lost $1,000 or $500. Okay. He didn't know that. It only showed one side of the trade. It didn't show that the equity was going, that the stock shares were going to be in his possession, which his broker knew, and his broker would immediately sell those shares and cover the $730,000, except for just a small piece of the spread. He didn't know that. He didn't know enough about it.
What caused that discrepancy? Was it the timing of the market open and close?
It's an aberration of an options trade. And in effect, what happens is the option trade settles on Saturday. The market's not open, so they can't sell the stock.
It settles when the market is closed.
Yes.
Oh.
So it settles when the market's closed and the market isn't open, so he can't sell the stock. So his brokerage account hasn't yet acquired the stock, but it would. Okay. And so it's simply a matter of a moment in time where one part of the trade was visible, but the other part wasn't and wouldn't be visible until Monday morning.
Yeah.
And on Monday morning, had he decided to just sit there and look at it, Monday morning, the thing would have changed completely and he'd been out about $500. Instead, it panicked him and he didn't know and didn't understand and didn't know who he could talk to find out, because it's a weekend, the brokers aren't open. And he just lost it and he committed suicide, which is horrible.
And they know
tragic.
that that's actually what happened.
Yeah, well, at least that's what Forbes reports. And we tested it to find out if, in fact, that's what would happen on another website. I won't mention it, but let's just assume, everybody, if you try to do some of this kind of stuff, that all of the brokerage sites may have that aberration simply by the way this account gets cleared. There's a spread of time when the market's not open where your account may show a big negative balance. We did it on a paper trade, and indeed, our account showed a $650,000 negative balance today.
Wow.
Which is so scary if you don't know what you're looking at right there.
Yeah, because it's, from what you're saying, it's not actually an aberration. It's actually the correct way it should go. If the trade settles on a Saturday and part of the trade is to sell the stock on Monday morning, that's what's supposed to happen, it sounds like.
Yeah, but the stock should show up in your equity account. I just think that that's something about the way these brokers manage it. And we're still digging into what's going on. And Robinhood is, as a website, has said, we've got to change this. We didn't even think about this. You do own the stock. I mean, you have an obligation to buy it and you bought it.
Yeah. Yeah.
And now you're $730,000 in the hole. And of course your broker won't let you do that. You don't have $730,000. They're not going to let you buy $730,000 worth of stock on a loan. They're not a chance, right? So there has to be an offset. And the offset is the stock is sitting in the account, but it doesn't show up, or he didn't look in the right place or something. We're still digging to find out. I've been doing this kind of trade for many years and never had this happen to me because I always exit the trades before they get into the spread. I just don't like risk, so we're going to exit that thing early. I've never been there over the weekend when something like this happened, and I didn't realize the brokers would have this kind of dumb accounting system that didn't tell you were okay. Wow. So anyway, that's just a warning for everybody. First off, if you don't know what you're doing with options, please don't do them, because 99% of people who trade options lose their money.
Yeah.
Yeah, that's the first step. And then if you are doing it, don't panic over a weekend if you've done a hedge trade.
You guys, if you enjoyed this video and you feel it was valuable in teaching you more about how to invest, hit the like button and please share the video with your friends. And if you want more investing content, subscribe to my channel. And don't forget to click the button on the screen. We got a free gift for you. Thanks again for watching.